Welcome to Accounting 20. In Accounting 20, we're going to start talking about some merchandising businesses. In your textbook, it's following along on page 270 to 298. I'm going to try to probably do this into two videos so that you can have a little less to look at each video. You're also going to notice the first couple units in our textbook are quite heavy. So don't feel bad if you don't want to listen to it all, but just know that it's here if you need it. So the first thing we're going to do is describing the three types of business operations. We're going to talk about a schedule of costs of goods sold. We're going to talk about recording transactions for merchandising accounts under the periodic inventory method using accounts. And we'll do the same thing with the perpetual inventory. And then we're going to talk about contra accounts for revenue as well. Okay, so there's a few types of businesses. There's three. Up to this point, accounting procedures have been illustrated mainly by reference to businesses such as physiotherapist clinic, a gym, a motel, a cinema, a contractor, a doctor's practice, a legal practice. All of these businesses offer services to their customers. They do not sell products such as mouthwash or tires. They sell services. They're called service companies. So any of you that have taken the Accounting 10 course before, all the accounting we did was for the service company. Okay, so in Accounting 20, we're going to move over into something called a merchandising company. A business that sells products, not services, is known as a merchandising company. Both wholesalers and retailers are included in this group. A retailer usually buys merchandise from the wholesalers or manufacturers and sell it to their customers at a price that covers their costs and a net income. A firm that converts raw materials or partially processed products into finished products is called a manufacturing company. And we're not actually going to be talking about manufacturing company in Accounting 20. Okay, so what the textbook likes to do is kind of introduce different companies, and then they use this further on in the textbook to teach you a few things. Pan Canadian Sports Equipment is a merchandising company. The accounting procedures of a merchandising company are a little different from those of a service company. The difference can be illustrated by examining Pan Canadian Sports Equipment, a retail store with a web-based storefront located in Ottawa. Pan Canadian Sports Equipment buys bikes, hockey equipment, baseball equipment, and so on. The goods bought from these various sources and sold to Pan Canadian Sports Equipment's customers are called merchandise. The merchandise inventory account includes the total dollar value of goods on hand for resale. In Chapter 3, you learned that expenses are the cost of goods or services used in the operation of a business. So you already know that revenue minus expenses minus your net income. A merchandising company must buy and pay, sorry, this shouldn't be an equal sign there. A merchandising company must buy and pay for the merchandise it sells, called the cost of goods sold, as well as pay the expenses of operating the business. The cost of goods sold account records all the costs associated with merchandise that has been sold. The following two equations illustrate how net income is calculated for a merchandising company. Okay, so we can go revenue minus cost of goods sold is equal to your gross profit, or your gross profit minus your expenses equals your net income. Net income occurs, of course, when revenue from sales exceed both the cost of goods and sold and the operating expenses. In the preparation of an income statement for a merchandising company, enterprise is a little more complicated, merchandising enterprise is a little more complicated than for a service business. Notice that there are three sections in the body of the statement: revenue, cost of goods sold, and operating expenses. Okay, so if you want to go back and look at those, you're more than welcome to. One of the major expenses for a merchandising company is the cost of the goods it buys for resale. Since the cost of goods sold is a major expense, it receives special attention on the income statement or in a separate schedule. So this is going to be something new that we haven't talked about before. A schedule is a supporting statement that provides details of all items on a main statement. In the income statement format used by Pan Canadian Sports Equipment, a single total $44,000 appears in the cost of goods sold section. It total includes all of the costs involved in purchasing the merchandise to be sold. It is arrived by the completion of the schedule of costs of sold. The use of this separate schedule simplifies the presentation. Okay, so if you look here, you have your cost of goods sold. It's just listed as 44,000. But down here, you will see that they actually showed how they came up with the 44,000. So they started with merchandise of 16,000. They purchased 51,000. So they added that to get 67,000. Plus they still haven't sold some of it, so they have to subtract the 23,000. So the cost of goods sold so far was 44,000. So the bottom part is the schedule that supports this number up here. And it just has its own special schedule so that it doesn't junk up your income statement. Okay, so if you're preparing a schedule of cost of goods sold, this is the equation that you would use. Okay, and we also have to think about too is purchases, returns, and allowances, purchase discounts, and transportation on purchases as well, which we will continue to talk about. Okay, so now here we're taking this a little bit further, and we've added in those last couple that we just finished talking about. So if you have a look at it, merchandise inventory was 23,000, adding in 62,400, less your purchases, returns, and the discounts that you gave to people, which totals 84,000. So you have to subtract this one and this one to get 54,000. And you have to add in 2,000 for transportation because it costs to transport those supplies. That leaves you with 56,000. Cost of merchandise available for sale is 79,000, less your merchandising inventory 29,000. So now you have $50,000 left. If goods that have been purchased and recorded in the purchasing accounts are returned, the cost of purchases will decrease. The purchases, returns, and allowance account is used to record such returns. So that's important. On the schedule of the costs sold, the amount shown for the purchase, returns, allowances account is a subtraction. Purchase discounts. When a cash discount off the invoice price is received, the discount is recorded in the purchases discounts account. Okay, so that's important too. The cost of the merchandise decreased because the decrease was received, the discount was received. Therefore, on the schedule, the amount shown in the purchases discount is subtracted from the amount of the purchases. The purchases figure less the total of the purchase, returns, allowances figure, and the purchases discounts figure equals the net purchase cost. Okay, so that was already shown to you, but that's just that little section. Transportation. The cost of merchandise purchased for resale is increased by the cost of transporting the merchandise to the retailer's place of business. Transportation shows how the transportation cost is added to the net purchase total. The 2,000 transportation cost is added to the 54,000. So 56,000 is your total, and it's called the total cost of merchandising purchased. The merchandising inventory account contains a total dollar value of goods on hand for resale. The schedule of costs of goods sold contains the inventory value at the beginning of the accounting period and at the end of the accounting period. The dollar value of the inventory may be determined in one of two ways: perpetual inventory and periodic inventory. The perpetual inventory method is commonly used by businesses that need to know exactly how much each item of merchandise is on hand. Under this system, records are kept for each individual item the company sells. The record is updated each time the item is purchased, sold, or returned. Most retailers have computerized point-of-sale terminals. When a customer takes an item to a computerized cash register, the clerk uses a scanner to record the sale. the same time, the computer deducts the item purchased from the stock or inventory so that a continuous updated record of items of merchandise is available. For more information on point of sale terminals, you can look at page 279. The accounting system used for perpetual inventory method is fully explained later in this unit. The periodic inventory method is used by very small business and retailers who do not find it necessary to keep continuously updated records. Businesses that use the periodic inventory method determine the value of the ending inventory by taking a physical inventory. So that's the difference. A physical inventory simply means counting all of the various types of merchandise on hand. The value of this inventory is then determined by multiplying the quantity of each item by its cost price and adding the cost of all the various units together. Some businesses sell a large quantity of relatively low price merchandise. For example, a variety store sells a lot of candy and potato chips. For these businesses, it is not practical to record the number of each item bought and sold every day during the accounting period. These retailers usually do a physical count of each item on hand and calculate the cost of merchandise only at the end of the fiscal period. The total value of the merchandise on hand is recorded in the merchandising inventory account. The value of the inventory is used on both the schedule of cost of goods sold and the balance sheet. So if you look here, here's a partial balance sheet. The current assets, cash, this is for Pan Canadian Sports, cash, 8,000, accounts receivable, 50,000, merchandising inventory, 29,000, and office supplies, 20. So their current assets are 89,000. Chart of accounts for a merchandising business. As you've learned, the income statement for a merchandising company contains new expense section, the cost of goods sold. For each item in this section, there's an account in the general ledger. Lists the accounts usually found in the general ledger of a merchandising company. Those accounts that are particular to a merchandising company have been highlighted. Notice that there are 6 sections in the general ledger of a merchandising company: assets, liabilities, owner's equity, revenue, and now new to us, cost of goods sold, and expenses. The general ledger of a service company has only 5 sections. Okay, so there's an example there. The ones that are in blue are going to be the ones that are new to us that we've never really talked about before. Debit and credit rules for merchandising accounts. In this chapter, you will learn additional debit and credit rules for the accounts of a merchandising company. The rules are based on the balance sheet equation. Okay, so we know that assets are equal to liabilities and owner's equity. Remember that income statement accounts are related to the owner's equity. The 2 basic principles that determine the debit and credit rules for the new accounts are: revenue increases the owner's equity, and expenses decrease the owner's equity. So expenses are put on the left side and revenue is put on the right side. Expenses decrease owner's equity and are recorded as debits. Expense accounts increase on the debit side. So they increase over here, they decrease over here. Revenue increases here and decreases there. For a business to record a net income or have net profit, the revenue from sales must exceed the cost of goods sold and the operating expenses, like rent, advertising, light, heat, and salaries. This revenue section of the income statement for Pan Canadian Sports Equipment for June. So if you look at it, this is just a section for revenue. You have store sales here. You have to subtract the returns and the discounts for a total of 2,000. That gives you 60,000. Plus, they're also making revenues from the internet, and they're subtracting any returns here as well. So the total, or the net sales, would be 78,000. Sales means the amount of goods sold for cash or on credit to customers during the accounting period. When merchandise is sold to customers, it is recorded in the sales account. Okay, so we're going to go through just a couple different transactions, and you can look to see how they're recorded. So transaction 1 is a cash sale. Cash register total for the day is 4,250. Internet sales were 425. So cash is debited with 4,675, and then you have your 2 forms of revenue there are credited. Transaction 2 is a credit sale. G. Giles purchased a pair of skates and 3 hockey sticks, $290 on account. So you need to debit accounts receivable G. Giles, and the credit will go to the store sales. And then just remember that we have a memo at the end of each transaction. And then if you were to record these into T accounts like we did in Accounting 20, they would look like this. There's always a chance that a buyer of merchandise may not be satisfied with the goods received. The goods may be wrong size or color, they may be defective, or they may be unsatisfactory for other reasons. The customer may return such goods to the seller for a full refund. The sales, returns, and allowance account is used to record that. Okay, so transaction 3, sales return on credit sale. G. Giles returned 1 defective hockey stick priced at $75 from merchandise purchased on June 2nd. So we need to debit this expense account and we need to credit the accounts receivable because we owe them, he owes us a little less now. The T accounts for that transaction would look like this. Transaction 4, sales return on a cash sale. Customer returned merchandise worth $25 together with cash sales slip for a refund. The goods were bought for cash on June 1st. Since the customer originally paid for the merchandise, a cash refund is given. Okay, so we need to debit that store sales returns and allowance, and then we need to credit our cash because our cash is going down. And the T account would look like this. Credit invoices. All business transactions must be supported by original source document. The source document that is completed when goods are returned is called a credit invoice. It is prepared by the seller, in this case Pan Canadian Sports Equipment, and sent to the customer. Copy is kept by the seller and used as the basis for the entry to reduce the customer's account. And the second item that results in a reduction in sales is a discount given for prompt payment. A discount given to a customer for early payment is called a sales discount. Such discounts are indicated in the terms of sale agreed upon between the seller and the customer. So this would be a credit invoice, an example of one. And it just shows that the hockey stick was defective. The amount would be $75. Okay, and there's different terms of sale. COD is cash on delivery. Receipt of invoice is payment is being made when the invoice is received. Net 30 is you have 30 days to pay it. EOM is at the end of the month. Sometimes things are due on the 10th of the month. Sometimes when it's listed like this, the buyer may deduct a 2% discount from the invoice amount if payment is received by the seller within 10 days. The full amount is due in 30 days if the buyer does not pay within 10 days. Or like this, a 1% discount may be taken if payment is made within 10 days. The full amount must be paid within 30 days after the end of the month. And it is common practice for firms to negotiate the terms of sale with their customers. Transaction 5, credit sales offering sales discount. Sold merchandise to WP Mulvihill, and it's listed like this. To encourage early payment, terms of 310 and 30 were offered. And on June 5th, Pan Canadian Sports Equipment accounts appeared as follows in the T account. Okay, so the person hasn't paid for it yet, so the full amount has to go to accounts receivable and to store sales. However, you received a check for an early payment. He decided that it was worth paying within 10 days because it meant a savings of $18.60. You find that by taking 3% of the full price. Therefore, on June 15th, exactly 10 days from the date of the invoice, payment was received. So now what has to happen is we do need to clear off of his account. So we're clearing it off with a full credit of $620. However, you're only receiving $601.40 to the cash, and you need to put that amount of that discount into the store sales discount. So the important thing is that this is zeroed out to show that they owe you less, but you need to account for that discount somewhere. And that's why you're going to use the store sales discount there. Okay, so in general journal form, these entries would appear as follows. You'd have one transaction for the full amount, and the second one would show the discount. And you see that those transactions are 10 days apart from each other. Okay, I think everything there should be good. Okay, there's an income statement. Okay, I think I'm going to skip through that for you. In the next part of this unit, the rules of debit and credit for cost of goods sold accounts will be described. Some sample transactions for Pan Canadian Sports Equipment follow. It is assumed that Pan Canadian Sports Equipment uses a periodic inventory system. So I think I'm just going to stop there for a minute and let you guys absorb that, and then I'm going to come up with another video.